Macquarie Group under fire. Shareholder rebellion over executive pay and leadership changes. Imagine a scenario where a multinational financial giant finds itself in the spotlight due to accusations of executive overpayment and regulatory lapses. This is precisely what's happening with Macquarie Group, where shareholder discontent has reached a boiling point. But here's where it gets controversial. Some stakeholders argue that the compensation packages for top executives are out of sync with the company's performance and regulatory challenges. On Thursday, Macquarie announced it would conduct a thorough review of its executive pay structures in response to a regulatory compliance lawsuit. This move comes just as some shareholders prepare to cast votes against the company's salary plans during the annual general meeting, AGM. Additionally, Chief Financial Officer Alex Harvey's unexpected retirement adds another layer of complexity to the leadership landscape. With no clear successor to current CEO Shimara Wickremaniaki, who took the helm in 2018, the company faces an uncertain transition period. The repercussions of these developments were immediately felt in the stock market. Shares of Macquarie Group plummeted by as much as 5% to $214, marking their largest intraday percentage drop in 3 months. This decline significantly underperformed the broader market's modest 0.2% gain. During a media call, Chairman Glenn Stevens acknowledged the close nature of the non-binding remuneration vote at the AGM. When questioned about potential shareholder opposition, Stevens expressed disappointment, but accepted the feedback as a necessary part of corporate governance. He stated, "It was always likely that there would be some observers who would say, 'You should have gone more one way or the other.' The outcome of the vote could be pivotal, with just 25% opposition needed to defeat it, and the possibility of shareholders demanding a board dismissal after 2 consecutive strikes. The stakes are high." These leadership changes and the impending pay review coincide with a significant regulatory challenge faced by Macquarie. The Australian Securities and Investments Commission, ASIC, has filed a lawsuit against the company alleging that it misreported up to $1.5 billion worth of short sales over a 15-year period, leading to market misinformation and breaches of post-financial crisis transparency regulations. Stevens emphasized that Macquarie is prioritizing the resolution of these regulatory issues and reinforcing its risk culture. He highlighted that when shortcomings are identified, the board takes swift action, incentivizes improvements, and reflects on how these issues might reflect on the company's overall organizational culture. In 2024, CEO Shimara Wickremaniaki received a staggering $30 million in compensation, positioning her as the highest-paid CEO among ASX 100 companies and the sole woman in Australia's top 20 highest-paid executive positions, according to the Australian Council of Superannuation Investors. Moreover, Macquarie reported a decline in its first quarter net profit, attributed to reduced contributions from its asset management arm and commodities and global markets unit. Although specific profit figures were not disclosed, the company provided insights into the factors driving this performance. The asset management division saw softer results, mainly due to the timing of investment-related income, while commodities experienced lower net interest and trading income in North American gas and power. As Macquarie navigates these challenges, it remains to be seen how shareholders will respond to the proposed changes. Will the leadership shakeup and pay review address the concerns raised by investors? Or will the controversy persist, casting further doubt in the company's future direction? These questions highlight the ongoing debate surrounding corporate governance and executive accountability in the financial sector. Macquarie Group CFO Alex Harvey steps down. What it means for the future. Shocking exit. Macquarie Group CFO departs abruptly, leaving regulators and succession speculators alike scrambling for answers. Imagine being on the cusp of potentially leading one of Australia's financial giants, only to abruptly step down. This is the stunning reality for Alex Harvey, the Chief Financial Officer, CFO of Macquarie Group Limited, who, after nearly 3 decades of dedicated service, has announced his departure. But here's where it gets intriguing. Despite his lengthy tenure and being a perceived frontrunner to helm the company, Harvey's exit comes at a time when Macquarie is navigating through choppy regulatory waters. A career marked by dedication ended by silence. At 54, Harvey's decision to leave, effective end December, with a full retirement slated for the following year, has raised more questions than answers. His 8-year stint as CFO, a role that has been pivotal in shaping Macquarie's financial trajectory, will now be handed over to Deputy CFO Frank Kwok. The Sydney-based firm's statement, however, remains mum on the reasons behind Harvey's sudden departure, fueling speculation. The regulatory storm and succession conundrum. Macquarie Group, currently embroiled in regulatory probes, faces not only the challenge of resolving these issues, but also the daunting task of succession planning. As the company navigates these uncharted waters, one cannot help but ponder. Will Harvey's departure impact the ongoing regulatory negotiations? And more pressing still, who will emerge as the new leader to steer Macquarie through these turbulent times? We want to hear from you. Do you think Harvey's exit will significantly alter Macquarie's approach to its current regulatory challenges? Should succession plans prioritize internal candidates with deep institutional knowledge or external leaders with fresh perspectives? Share your thoughts in the comments below. Macquarie Shakeup. CEO and CFO exits amid 24 million pay and regulatory fury. Imagine a world where a single executive's paycheck could spark a financial storm, causing ripples throughout a major investment bank. That's precisely what's happening at Macquarie Group, where the long-serving Chief Financial Officer, Alex Harvey, is set to leave the company amid a shareholder revolt. The bank faces the prospect of its first-ever strike at its annual general meeting in Sydney, where 25% or more of shareholders are poised to vote against the company's remuneration report. The outrage? Macquarie hasn't cut back on executives' pay, despite a series of compliance wonders that have attracted the scrutiny of financial regulators. But here's where it gets controversial. Alex Harvey's departure comes on the heels of a lawsuit filed by the Australian Securities and Investments Commission, ASIC, against Macquarie Group. The suit alleges that the company engaged in misleading conduct by misreporting millions of short sales to the market operator for over 14 years. This is just the latest in a stream of 4 actions against Macquarie entities by ASIC since last year, following compliance failures in its derivatives trading arm. And this is the part most people miss. 2 influential proxy advisory firms, CGI Glass Lewis and Ownership Matters, have criticized Macquarie for failing to adequately reduce executive pay. They argue that the measures taken to cut the profits flowing to Macquarie's CEO, Shemara Wikramayake, Australia's highest-paid CDO, and Macquarie Bank boss, Stuart Green, are not sufficient, given the long list of regulatory issues. Ownership Matters report suggests that Wikramayake's profit share dropped by up to $2.5 million, while only one other disclosed executive saw a decline in profit share. The controversy doesn't end there. Several major international investors, including Californian pension funds CalPERS and CalSTRS, as well as SBA Florida, have indicated they will vote against the remuneration report. As of the time of writing, Macquarie Group Limited shares have already dropped by 4.63%. In an attempt to quell the storm, Macquarie chairman Glenn Stevens defended the bank's risk culture in a speech to investors. He emphasized that the board holds staff accountable and seeks to incentivize future improvement. But here's the kicker. Stevens acknowledged that while Macquarie's remuneration system is strongly supported by shareholders, a number of them feel the board has not adequately reflected risk shortcomings in their FY25 decisions. But here's where you come in. Do you think executives should be held more accountable for compliance failures? Should their pay be tied more closely to regulatory performance? Or is this an overreaction by shareholders? Let us know your thoughts in the comments. As Macquarie moves forward, it promises to direct significant resources into remediation activities and reinforce its frameworks, systems, and controls. The bank remains optimistic about its future, citing its diverse income streams, patient growth strategy, and strong risk management culture. But the question remains, how will Macquarie navigate the turbulent waters of regulatory scrutiny and shareholder dissatisfaction? Only time will tell.